Hello good people, it's me Kumanawa, your money manager. In today's video, I want to take you through a term life insurance policy versus a credit life insurance policy. This video is created for you. If you're somebody who is looking into getting a loan, or maybe you do have existing loans, I want to remind you that loans and insurance are inseparable. No lender is going to give you money and not want to protect or cover the risks that they're going to be exposed to. And the first risk that they're exposed to as your lender is the risk of you dying while the loan still has a standing balance. So that's a huge risk that they're facing. The second risk that they're facing is a risk of default, risk of you not being able to repay the loan in full. So insurance is meant to cover the first risk. Please always remember that this insurance policy that you're taking is not meant to cover default risk. I want you to have this at the back of your mind. So please, this is me today with a totally different look, a different hairstyle. Please don't mind my hairstyle. I actually plaited myself. I'm a hairdresser as well. So don't be surprised if I tell you that I am opening a salon business. But let's get on to the business of the day. We are looking at term life insurance policy versus credit life insurance policy. Let's first try to understand these two different types of policies. Term life insurance policy. This is a life insurance policy that pays a lump sum benefit upon the death of the insured person during the specified time period. Like the name is saying term, it means that there's a beginning and there's an end. So there's a specified term that this insurance or the lump sum benefit can be paid. Normally it can be 5 years, 10 years, 15 years, 20, 25 years, 30 years. It really depends up to you, because the longer the term that you pay, the higher the premiums that you are going to pay for this type of insurance. Let's look at a credit life insurance policy. A credit life insurance policy is a specialized type of insurance. It's a policy that pays off your debts if you happen to die before your debts are fully paid off. So like the name, the credit, this type of an insurance policy is linked to your credit or loans. It applies to all different types of loans. It offers protection purely to the lender. So the benefit of this policy is your lender, somebody who has got borrowed you money. So when we look at the term life insurance policy, there you can specify who your beneficiary is, somebody who's going to receive the benefits upon your death. So there you specify your beneficiaries, but with a credit life insurance policy, your beneficiary is first your lender. Let's look at the credit life insurance in details. The most common one is the reducing debt benefit. So with this type of a credit life policy, what happens first is that the term of the policy corresponds with the term of the loan. If you've taken a personal loan and the personal loan is for 5 years, also the credit life insurance is also going to run for 5 years, corresponding or aligning with the term of your loan. Secondly, we need to know that this type of a policy, the credit life insurance, the death benefits are going to reduce as the debt balance reduces. So this is why we say it's a reducing benefit, because the benefits are reducing as your loan is reducing over time. Let me give you an example here. Let's say you have taken out a personal loan of 200,000 for 5 years, and at year 3 the balance on your personal loan is only 100,000. Your benefits for your credit life policy are also going to be only 100,000. So if it happens that you die at year 3 when the loan balance is 100,000, there is a corresponding 100,000 benefit that will be paid to settle off your outstanding balance. This is the most common type of credit life insurance that we are offered out there. However, in some instances you can find another form of credit life policy that is called level death benefit policy. So with the level death benefit policy, what happens is that death benefit is going to remain constant throughout the term of the loan. As the loan balance is reducing, the death benefit will be constant throughout the term. Let's go back to our example of a 200,000 personal loan. So in year 3, the balance is 100,000. However, the death benefit is still going to be 200,000. So if we happen to die at year 3, the benefits are 200,000, the balance is 100,000. So they will pay the balance of 100,000, and there's going to be the other 100,000 that can be passed on to your beneficiaries. Because of this level term, it tends to be more expensive than the reducing debt benefit. So these are the two types of credit life insurance policies that you can find out there. So you need to inquire on the type that your lender is offering you. So with the explanations that I've shared, somebody could be asking, is there really a need for me to go and take up credit life insurance policy? It really depends. But what we normally say is that when you have an existing life cover, there's no need to duplicate efforts. What you'll be basically doing is you're duplicating efforts, you'll be paying double for something that is unnecessary. The same life cover that you have can be used to provide the same protection that the lender is looking for. What you basically need to do is just to cede the policy to the lender. What we mean by ceding the policy is that your underwriter or your insurance provider will note the interest of the lender such that if anything happens to you, you die, then they will settle the outstanding loan balance first before they can pass on the remaining proceeds to your beneficiaries. So there's no need for you to duplicate efforts. But sometimes we find ourselves in a situation whereby we cannot qualify for a life insurance policy. We're ineligible for life insurance policies. Mostly can happen maybe due to medical reasons. And with a credit life policy, there is no medical underwriting. You don't have to go through medical tests and all of that. By virtue of being a borrower, you can qualify for this type of a credit life insurance policy. Therefore, if maybe you are facing any of that, that is when maybe a credit life insurance policy will make sense for you. But then, how is it that we find a lot of ourselves with credit life insurance policies that we are even unaware of? What happens is that, unfortunately, we find ourselves dealing with lenders with unfair practices. Some lenders will not even disclose to you that, the credit life insurance policy is not, it's optional. Meaning that if you have your own life insurance policy, you can bring it, they can accept it. They're just going to keep quiet, but what they will do is they will take the cost of this credit life insurance policy, roll it into the loan agreement, and over and above that, they'll finance it. When they finance the premiums of this credit life insurance policy, it means that you are going to pay interest on the financed portion of the premiums. So typically what happens is that you will get approved, let's say for 200,000, and instead of receiving the 200,000, you're going to receive less. If maybe the cost of this credit life insurance policy is 10,000, we'll deduct the 10,000 from the 200,000. Now you're going to get 190 or close to that, and the 10,000 is taken and is going to be used to pay for the cost of the credit life insurance. And on this same 10,000, you are going to pay interest on it. So it's very important for you to always make sure that you read that loan agreement, and where you notice things like credit life insurance policy, loan protection policy, please inquire. You just need to ask first, how is this credit life insurance financed? Can I finance this separately if I can, or is it rolled into the loan, or is it financed by you as a lender? Because by financing it separately, it means that you can avoid the unnecessary interest cost. And you also need to find out, yes, I see that it's written here that there's a loan protection that is required, but I do have my own life cover that is already in place that I can bring for you to cover this loan. Yes, they will accept that. They'll gladly accept that. Nobody will say no to this. Unfortunately, sometimes we are going to find ourselves in agreements where maybe our employer has negotiated a scheme, and as part of that scheme, they've made it mandatory that you get their own credit life insurance. I mean, if you find yourself in that situation, that then is your employer's doing. It's not the lender's doing, it's their employer's doing. They've agreed to these terms, and this is disadvantaging you in a way. So we need to be aware of the decisions that we are making, and we need to always understand that loans and insurance are inseparable. This is all that I wanted to share with you today. Please, I hope that this video will help you as you go out there and take loan products. You also make sure that you are aware of the insurance policy that you are taking. This is all that I wanted to share with you today. Please don't forget to leave a comment and a like for me. Thank you so much for your time. I will see you in another video.